Okay, and welcome back, students who are taking financial accounting. And in this chapter, in this series of videos, we are working on the theory for this chapter, which is on for chapter 12, which is on financial statement analysis. And in the last video, we had covered vertical analysis and horizontal analysis. Once you've generated the numbers, now you're actually quote unquote doing the analysis. Now you're going to do the thinking part of it and making judgments as part of that analysis. So what we have to look at is trend percentages. All right. So read this. I'm not going to spend a lot of time on this. Okay, but read this in the textbook. All right. You're going to have when you're doing when you're looking at analysis and trend percentages, there's 5 key questions. Question 1 is the business a going concern? And this idea of the going concern, right? You would ask, why are you even asking this question? Okay. Well, I mean, if it's a profitable business, you're not so concerned about whether it's a going concern. A going concern means whether it's still going to stay in business. But when the business is having a hard time, like for example, you've seen, your statement of cash flows shows that you don't have any cash. Remember, cash is king. Okay, then you have to start asking yourself whether this company will be able to stay in business. So that's a question that you want to ask yourself: is the business a going concern? Is it going to stay in business? 2, how is the business earning a net income or loss? All right, you want to think about, you know, uh, you know whether your sales are up, whether your sales are down, your if your gross profit is going up or down based upon your costs, that type of thing. All right. 3, where is the business getting its money and can it pay its debt obligations? All right. Um, so, yeah, where's the money coming from? I mean, is it coming from sales or is it coming from loans? And if it's coming from loans, can it pay its debts? Right. Question 4 is how is the business investing its money and is it using its assets efficiently? Okay. When it makes a profit, is the business taking the money out of, are the shareholders, the CEO, are they just siphoning the money out of the business or are they pumping the money back into the business and buying the required assets to be able to run the business? And 5, is the business generating enough income to reward the stockholders for the use of their money? Remember, if you're a publicly traded company, you have shareholders there. They're going to expect a return on their investment. It's not just about the appreciation from the price of the stock. All right, they kind of do expect to get a return on investment in form of dividends. Now, the thing about these 5 key questions is that you have specific ratios, right, that delve into, that allow you to look at each one of these particular questions. And in the textbook, I had to cut this up into 2 different slides, okay? Because it's just too big to put on one slide, right? But if you can see here, here's the 5 key questions, and these are the ratios used to analyze and make the decision. So, as an example, this is question number 1: is the business a going concern? And these are the different ratios that you will look at in order to be able to answer this question. All right. Now remember, all of these here ratios you've had before, either in Math for Business and Finance or Math Applications, and you've had them at the end of each chapter of this textbook in your focus on decision making. So I'm not going to cover each one of these ratios. Go back and watch the theory videos. Like I had said in the um, introductory video for this chapter, I gave the web address for the Math for Business and Finance if you need to take a look at it there, okay, as another source to see the theory, or look at the theory videos at the end of each chapter that pertain to whichever one of these ratios if you don't understand them. But by now you really should have a handle on these, on how to calculate these ratios, so I'm not going to go over it. But the important thing here is that, this here is question 1, is the business a going concern? And these are the ratios that when you use to analyze to answer that question. Question number 2 is, how is the business earning a net income or loss? You have your gross profit percentage and your net income percentage. Number 3 is, where is the business getting its money? Can it pay its debt obligation? Okay. Um, use the debt ratio and the interest coverage ratio. Number 4 is, how is the business investing its money, and is it still using its assets efficiently? So you look at these ratios for that. And question number 5 is the business generating enough income to reward stockholders for the use of their money? So these are the different ratios that you use in order to answer that question. All right. Now, the thing about these ratios is, again, it's not about getting just one answer. Okay, like for example, a current ratio. All right. It's not by taking current assets and dividing by current liabilities, right, and getting an amount. Let's say that ends up being 1.2 for the year 2014. Well, what does that mean? That number doesn't mean much in and of itself. The numbers are best used in comparison to something else. So if in 2013 we had 1.5, say, okay, this is a good thing. All right. You're able to compare one to another, right, and see whether that's whether that ratio is the number for 2014 is beneficial or not. Now, I'm stumbling and babbling here a little bit because I'm trying not to get into the specifics of this. Okay, again, the theory behind these ratios were covered in Math for Business or in previous chapters in the Focus on Decision Making. The best way to get a handle on these numbers is to play with them. Like, for example, current assets versus current liabilities. Let's say my current assets, I'm looking for a place to write here. Let's say my current assets are 100,000 and my current liabilities are 50,000. Okay, so if I divide 100,000 divided by 50,000, I get a current ratio of 2.0. Right? Now that doesn't mean much by itself, but if I change my current assets to say 75,000 and my current liabilities stay at 50,000, right, divided by 50, now it ends up being 1.5. Okay, so if in 2013 I was at 2.0 and in 2014 I went down to 1.5, is this good or is this bad? Okay, that's the way you need to look at it. Why is it good or why is it bad? Well, my current assets went down. Okay, means I have less in assets, all right, in order to pay off the obligations and my current liabilities. So what I'm getting at here is to know whether these numbers are good or bad. What you do is you play with different scenarios, just like I did here. Well, what happens if I went and said, okay, instead, the current assets were 75,000 here, and my current liabilities were 30,000. Okay, well, 75 divided by 30 means I would have had a ratio of 2.5. Right? So I would have had 2.0 from the previous year, but now it's 2.5. Is that good or is that bad? Well, in comparison, okay, that's because the current assets went up, that's a good thing, right? Even though my assets are lower than the year before, my liabilities are much, much lower, right? Meaning I have more assets to be able to pay off the liabilities, all right, of 30,000. So by the number going up, that's a positive thing. So that's how you look at these ratios, okay, and to be able to think about them. So if you're ever, stuck where, you're being given numbers and you're not knowing, whether 1.5 is good as compared to 2.0, work through different scenarios in order to get a feel for that particular ratio and how it works to be able to determine whether going from 2.0 to 1.5 is good or bad. Just because it goes down, a ratio goes down, does not mean it's a bad thing. It all depends upon the ratio. It could mean that is both. It could mean it's either good or bad. It's not necessarily just bad just because it goes down. Okay. Again, so I just showed you how to work through the ratios and set up different scenarios and play with them in order to be able to understand that particular ratio. And when you understand that particular ratio, now you can make a judgment as to whether the change in the number is a good thing or a bad thing. All right. So this here particular slide and the next one here, all right, um, you know, as you can see, this is exhibit 12-10 in the textbook, okay? In future editions of that exhibit number may change, but this is basically a listing of all of those percentages, all of those ratios that you use, and the questions that they answer, all right, that pertain, the ratios that pertain to that particular question. So this here is one of those quote-unquote cheat sheets that you want to hold on to, okay? If I'm going to look in the textbook, and I'm being asked about, let's say I want to think about, I don't know, my gross profit percentage, okay? Right? I'm not going to be trying to find that at the end of each chapter, okay? I'm generally going to have this page bookmarked or tabbed or whatever, and I'm going to come here in order to be able to get a quick listing of the different ratios. Same thing happened in the Math for Business and Finance. They presented it over the course of the chapter, but at the end of the chapter, they gave a listing of all of the different ratios, assuming that you've read and studied the chapter so that you know what they mean, okay? So use this here exhibit as a template, as a cheat sheet for one place to go as far as your ratios are concerned, right? And that's kind of like what you're doing when it comes to analyzing the financial information. You start out by either using a vertical analysis, right? You're taking your financial statements, whatever they are, the balance sheet, income statement, whatever, and you have your data for different accounting periods, depending upon whether you're using vertical, which means up and down, or you're using horizontal, right, which means left and right, right? You start out with your basic data, and then you create this additional information here, all right? Now, that's a mechanical process. You're just creating these numbers. You're not analyzing it just at that point in time. Once you have those numbers generated, now you start looking at, your trend percentages. You start calculating the different ratios that you need in order to be able to answer specific key questions about the business. That's why this chapter is called Financial Statement Analysis. These are the major questions that you're trying to answer about the information that's on your financial statement. And if you work through all of these here ratios and can make the proper assumption about that particular question, when you put this all together, you can sit there and say, okay, this business is a good business or it's a poor business, or here's where there's a strength and here's where there's a weakness. All right, and that's what you're doing, taking the basic, uh, we've kind of like gone full circle. You've taken the basic information that started out by making journal entries, all right, and posting them to your ledger accounts, which allowed you to create your financial statements. Now we're taking those financial statements and we're analyzing the information on them in order to be able to see, how the business is actually doing. All right. So with that said, I'm done with all of my babbling here, and it's the end of the chapter. I will have one more video here for the focus on decision making. And with that, we'll be done with the textbook. All right, so I'll see you in the next video for focus on decision making.